Hi there. So we want to continue with our masterclass on the IPSAS, and we want to continue to IPSAS 11, that is construction contract. This is the same as IAS 11. Now note that IAS 11 and IAS 18 has been replaced by a new accounting standard. So if you are doing financial reporting, you'll be doing IFRS 15, which is actually a replacement of IAS 11 and then IAS 18. But IPSAS 11, construction contract, is just based on IAS 11, and we're going to be using the thoughts and the concepts there to be able to understand how construction contracts, revenue from construction contracts, can be recognized in the books of a public sector organization. So as always, we're going to be looking at the objective, we're going to be looking at the scope, we're going to be looking at a couple of definitions, we'll look at some recognition criteria, and then we will start to delve deeper and look at the each segment of the standard and get it into how we can recognize various items and various things in the organization. Remember that I made a couple of references to construction contracts when we were doing IPSAS, is it 9? That is revenue from, how's it called? Revenue from exchange transaction. I made a reference to IAS 11. IPSAS 11, that we will be looking at how we can recognize percentage of completion, and I said I'll be dealing with that deeper here. So what is the objective of this standard? Let's go into it. The objective of this standard is to prescribe the accounting treatment of costs and revenue associated with construction contracts. So primarily, their objective here is to how we will treat the revenue and associated costs for a construction contract. So let me give you an example. Let's say that a public sector entity is undertaking a contract for 2 years, and the contract price is, say, $20,000, and they expect to incur a cost of, say, $18,500. What it means is that they expect to make a profit of $1,800. Now, if they have done, let's say they started in January and it will end in December in the following year, and that is for the 2 years. So let's say that at the end of the first year, how will they account for it? This standard is going to prescribe the revenue that they can recognize, the cost that they can recognize, and then the profits that they can also recognize in their book. Pro forma wise, what is going to happen is that we're going to be finding out about the difference between the total cost we expect to incur to finish the product, so that we look at the total profits we will be having if we finish with the job. So that is going to guide us in relation to how we're going to be recognizing revenue and how we're going to be recognizing the cost. Then, based on that, we'll be having information about how we can determine the percentage of completion, because it is the percentage of completion that will guide us in how we can allocate the revenue and we can allocate the profit so that we can determine the cost of sales. So hypothetically, if you are preparing an income statement using this standard, now we'll get into this a bit deeper, but I just want to let you know about it. We're going to be bringing the revenue, which is going to be based on percentage of completion. All right. Then we're going to be bringing profits recognized, which is also based on the percentage of completion. And then the balancing figure, okay, will be the cost of sales. So this is the income statement issue. This is how we're going to be recognized. So if this is the profit we made, and at the end of the first year, percentage of completion, we are using the input method. So percentage of completion will be cost incurred to date divided by total cost times 100. And we got that as 20%. If we have done 20% of the job, we take 20% of the revenue as the revenue here. We take 20% of the profit as the profit here. So the difference is what is going to give us the cost of sales. That is how we recognize this in the income statement. So this is the income statement, or if you want, the statement of financial performance. Now when we go to the BS, excuse me. Now when we go to the statement of financial position, what do we do there? In the statement of financial position, we have to recognize a contract asset or a contract liability, and the pro forma for that is that we're going to bring in costs incurred to date. We'll get into this later on. Then we'll bring recognized profit or loss. Okay, if it is profit, we add, it's a loss, we deduct it. Then we will bring the receivables, that is the work certified for us, the invoice we're going to be giving to them. Okay, that is going to be deducted. And then the figure we get here will be the contract asset or liability. If it is positive, it's an asset. If it is negative, it is a liability. So that is also the idea about that. Now, if we want to know how much is outstanding for the invoice, we will look at the difference between the invoice, which is how much we are supposed to receive, minus the cash received. And that is what will give us the receivable that will be taken to the statement of financial position. So in the statement of financial position, we're going to be doing this for the contract asset. And then if we have not received all the invoice, the balancing figure will also be taken under receivables in the statement of financial position. So basically, these are the key thematic issues that you have to know, you must understand when we are dealing with the IAS 11. So let's go back. So in a nutshell, you could see how we are treating revenue, and you will see how we are treating the profit, but the cost. But most importantly, what we want you to be able to do is your ability to present the transaction in the statement of financial performance and know what has to be going into the statement of financial position, because that is critical and that is fundamental to your studies. So let's move ahead with what we have here. The standard I identifies the arrangements that are to be classified as construction contracts. That's the first thing. So we're going to be having which arrangements can be classified as construction contracts and which cannot be classified II. Provides guidance on the types of construction contracts that can arise in the public sector. There are various types of construction contracts that can arise. We'll be getting deeper into that in a moment. And then 3, specifies the basis for recognition and disclosure of contract expenses and, if any, contract revenue. So what will be the basis for the recognition? And one of it is what I illustrated to you here, where we are using the percentage of completion to recognize the revenue and the expenses, or if you want, the cost under a particular contract. Now, because of the nature of the activity undertaken in construction contracts, the date at which the contract activity is entered into and the date when the activity is completed usually fall into different reporting periods. And that is what I said earlier. So maybe you know that Ghana, our year ended is 31st December each year. So if the public sector organization signs this 2-year contract in August, okay, in August 2018, then for the year ended 2018, they will do, let's say 1st August. If it is 31st August, then August will not be passed. But if it is 1st August, then August will be included. So 1st August, so August, September, October, November, December. That is going to be 5 months. It means that we are going to be calculating the percentage of completion, or whatever it is that we're going to be recognizing will be based on what? The 5 months period that we need to look out for in relation to that. So these are some of the things you must understand about the objective, what the standards aim at doing. So let's look at the scope, what the standard covers, what we are expected to know through all the standard. So 1, a contractor which prepares and presents financial statements under the accrual basis of accounting should apply the standard in accounting for construction contracts. You know this already? You know this already. So anybody, any public sector entity, a contractor that prepares financial statement using the accrual basis, then you're going to apply the standard in the preparation and presentation of your financial statements. So let's look at a couple of definitions here in relation to construction contracts. So number 1, What is construction contract? Alright, that is the name of the standard IPSAS 11 construction contract. So what is a construction contract? A construction contract is a contract or a similar binding agreement specifically negotiated for the construction of an asset or a combination of assets that are closely interrelated or interdependent in terms of their design, technology, and functions, or their ultimate purpose or use. So when we say construction contract, simply a binding agreement between two parties where you are constructing an asset or interrelated asset. So for instance, if a public sector entity has been contracted to build a road, to construct a road, or build a hospital, so to construct a road, that could be one thing. But if maybe they say construct a road, and because the road passed a waterlogged area, construct a bridge, or because the road is going to be very busy, construct a footbridge. So some of the projects will be similar and will be interrelated into one contract in relation to that. 2. Who is a contractor? A contractor is an entity that performs construction work pursuant to a construction contract. So if we are the public sector entity that is undertaking the contract, boom, then we become what? The contractors. And definitely, we are the people who are going to be dealing with this standard in our books. Next, cost plus or cost-based contracts. Cost plus. Now, you see, when it comes to the negotiating of the contract and determining of the price of the contract, there are a couple of ways through which the value of the contract or the amount to be charged are going to be determined. One of those ways is the cost plus. Now, if you did management accounting or you did costing or you understand management accounting, you know that cost plus simply means you estimate the total cost you expect to incur on the project, and then you mark it up with your profit markup or profit margin, and then boom, you're going to get what? Your selling price for that product. So cost plus or cost-based contract is a contract in which the contractor is reimbursed for allowable or otherwise defined costs, and in the case of a commercially based contract, an additional percentage of these costs or a fixed fee, if any. So whatever money you spend, we're going to be reimbursing you. But if it is going to be a commercial purpose, then we are going to provide you an additional money. That is going to be our profit in relation to that. Then fixed price contract. Look at the name, fixed price. Meaning with this one, it's not about being reimbursed, it's not about being added an additional money. We negotiate. Okay, this is $10 million. Boom, you take it and go away. I don't know what's wrong. Fixed price contract is a construction contract in which the contractor agrees to a fixed contract price or a fixed rate per unit of output, which in some cases is subject to the cost escalation clauses, escalation clauses. So these are clauses. These are the two ways that a contract price can be done. With a fixed price, we agree. As I said, $10 million, boom, you go away. Or better still, we are going to be charging the rates per unit or per output. So if, for instance, we are producing water for you, then we're going to be charging you based on the cost, based on each bottle. So each bottle, we're going to be incurring maybe, 50 pesos. Then you're going to pay us 60 pesos for each bottle we produce at the end of the day, and that is the idea about that. So these are some core definitions you have to understand about the standard. So let's get deeper into some of these things and take these definitions one after the other and delve a bit deeper in them. So construction contracts. Now, this standard defines or further explain what should include a construction contract. Remember we said it is what? A binding agreement or arrangement negotiated to what? Produce an asset or interrelated what? Assets. But so what includes, what is contained, what can we describe as a construction contract? So let's go through that. For the purpose of this standard, construction contracts include the following. A. Contracts for the rendering of services which are directly related to the construction of the asset. For example, those for the services of project managers and architects. So are you seeing the relationship here with IPSAS revenue from non-exchange transaction? With exchange transaction, where we are looking at rendering of services. So here, a construction contract includes where the entity is rendering a service in the form of project manager or an architect. 2. It also includes contracts for the destruction or restoration of assets and the restoration of the environment following the demolition of assets. That's also the thing. Those times when Van der Poel, the then mayor of the Accra Metropolitan Assembly, was demolishing a lot of structures across the metropolis. What we're saying here is that if those things are demolished, so the people who demolish, okay, it's a form of construction contract. If the public entity is involved in that, it's a form of construction contract. Then, if the place is demolished and now we are restoring the place, we are leveling the place so that it will be used for another purpose, that arrangement is also part of what? Construction contracts. So these are the two things that it entails. So it could be services or it could be a physical thing that we are doing. Because really, an architect's job may not be seen because he will draw everything on paper so that the contractors can go and build. The project manager is not there to build, he's there to direct, this is how this should go, this is how, so that is rendering of service. Then if you are now building, that is also part of the construction contract. Please note, construction contracts are formulated in a number of ways, which for the purposes of this standard are classified as fixed price contracts and cost plus or cost-based contracts. And I've already gone through that. So we formulate a contract either with a fixed price or the cost plus method in relation to that. Also, note that when a contract covers a number of assets, the construction of each asset should be treated as a separate construction contract when, let me take that again. When a contract covers a number of assets, the construction of each asset should be treated as a separate construction contract when separate proposals have been submitted for each asset. So if we have been contracted to do a lot of projects, maybe at a certain location or in a certain municipality, we are building toilet facilities, we are building hospitals, and we are constructing roads. The standard says that for the construction of these different assets, we would treat the expenses and treat everything as a separate contract when we submitted a different proposal for each of the contracts. That's very important. It means we submitted a different proposal for the toilet facilities, we submitted a different proposal for the hospital, we submitted a different proposal for the construction of the road. Then, in that case, since they all have different proposals, we will treat each contract as a separate contract. What it then means is that if that is not the case, then the three will be treated as a single contract. That is, if we submitted one proposal for the three, then all the three will be treated as a single contract. It's very important for you to get that. B. Each asset has been subject to separate negotiation and the contractor and customer have been able to accept or reject that part of the contract relating to each asset. So the two, the contractor and the customer, have sat down and agreed on each of it. Okay, how we want the toilet facilities will be, this is how much we're willing to spend on it. How we want the hospital to be, this is how much we are willing to spend on it. How we want the road to be, this is how much we are willing to spend on it. Unlike where it says the 3 projects we are spending this, then in that case that is going to be a single project. But if each of the projects, the two people, that is the contractor and the customer, agrees, then we have to treat them separately. And then the third thing is that the cost and revenues of each asset can be identified. The cost and revenue of each asset can be identified. So number one has to do with what? Proposal. We submitted separate proposal. Number two, the contractor and then the customer agreed and negotiated separately each of the assets. Okay, so separate negotiation. Then number three, the cost and revenue of each of the components of the assets can be what? Recognized. That is when we will recognize them in relation to that as a separate contract. If these three things are not there, then the contract or the various number of assets will be recognized as a single contract. Note also, a group of contracts, whether with a single customer or with several customers, should be treated as a single construction contract when a group of contracts is negotiated as a single package. It goes back to what I said. So when we have a group of contracts, supply desks, supply computers, supply books, and even though these are three separate things, they were all negotiated and agreed upon in a single package, then we will treat that as what? A single contract. 2. The contracts are so closely interrelated that they are in effect part of a single project with an overall margin, if any. Like the illustration I gave you earlier, we are constructing a road, and the road is certainly going to be passing through a marshy area. And so if we're passing through a marshy area, then there has to be a bridge somewhere. Or we are constructing a road in a town or in a city where it's going to be busy day. So we need to construct a footbridge. So, because these things are necessary, interrelated, and cannot be done without the construction of the road. So that is going to be in it. In that case, we will treat the two activities as a single contract. Then number 3, the contracts are performed concurrently or in a continuous sequence. The contracts are performed concurrently or in a continuous sequence. So, like there is a new road being constructed around. At the time I'm shooting this video, there is a road I wanted to use. I passed through that place not long ago. Around Kwabenya there. Now, when you go there, you realize that there are people working on the bridge because there's going to be an interchange. So there are people working on the various pillars for the interchange. There are various people working on the main road. There are various people digging in relation to. So you realize that the job is being done concurrently. Then there are some of them, they cannot be done without another. So it's going to be continuously. So if the projects are like that, then certainly we treat a contract as what? A single contract. Finally, a contract may provide for the construction of an additional asset at the option of the customer, or may be amended to include the construction of an additional asset. The construction of the additional asset should be treated as a separate construction contract when So this is what we are saying. There are some times when, as at the time we agreed on the contract, there was no number of assets. But as we continue with the contract, the customer says, oh, I guess if you add this, it will not be bad. We are saying that if that happens, then that additional assets that the customer is requesting should be treated as a separate construction contract when the following conditions are met. Number one, the asset differs significantly in design, technology, or function from the asset or assets covered by the original contract. So if the asset differs, then no fee. So we are constructing a hospital, then they said, oh, since you are in this town, why not construct some toilet facilities? Hospital toilet facilities, yeah, in the long term we can draw some correlation between them, but they are not related based on design, based on technology, they are not related. So in that case, they have to be treated as a separate contract. But if they are related, then we will treat it as a single contract. Then two, the price of the asset is negotiated without regards to the original price. So if the price of the asset is negotiated without regards to the original price, so the hospital, we are charging $20,000. Then the toilet, they said we negotiated that differently for say $5,000. In that case, then we have to treat the additional asset as what? A single contract. But then, if during the negotiation they said, oh, we are paying you $20,000, can we add some $2,000 so that you can do the asset for us? Meaning that they are making reference to the original contract price. Then in that case, the additional contract asset will be treated as a single construction contract in conjunction with the area contract in relation to that. So these are the various fundamental principles and concepts that we have to understand in dealing with the issue about construction contract. Now, so let's get into the bigger picture. How do we recognize revenue? How do we recognize expenses in construction contracts? How do we do that? I've given you some glimpse already, but we are going to be diving a bit deeper into looking at the various things. And most of the things here, you may remember them already from IPSAS 9, revenue from exchange transaction. And I'll continue with that in the next video. So I'll see you in the next video as we continue with IPSAS 11 construction contracts.